If you read the headlines, DigiPlus is a digital gaming app getting crushed by government regulators. But while retail investors are dumping their shares, the company is quietly buying up a luxury casino in the heart of Manila. The panic started with the first quarter earnings. The company reported a 33% profit crash, down to 2.8 billion pesos. That drop traces directly back to a sudden, aggressive move by the Bangko Sentral ng Pilipinas. Regulators ordered all major e-wallet providers to sever their links to online gambling platforms. By removing that frictionless one-tap deposit feature, the industry suffered an immediate 50% plunge in online gaming transactions. That regulatory shock hit exactly as the national inflation rate spiked to 7.2%. Surging food and transport costs are actively squeezing the middle class, evaporating the discretionary income that casual players normally spend on entertainment apps. The combination of severed payment channels and a tightened consumer wallet sent Plus shares into a steep slide. From the outside, the narrative looks bleak. The transaction volume is down, the stock is red, and the casual user base is shrinking. It looks like a classic textbook short setup for retail traders. And that is exactly why the broader market is completely mispricing what comes next. To understand the actual health of DigiPlus, we have to ignore the temporary dip in casual volume and look at the underlying capital. Management reports that by May 2026, over 50% of their user base has already migrated to their dedicated proprietary apps. This migration is being led by high-value players who drive the bulk of the company's revenue and are willing to navigate the new deposit friction. This user retention is backed by a balance sheet that defies the current economic climate. While consumer tech companies typically carry heavy leverage, DigiPlus operates with a total debt load of only 745 million pesos. Compare this to their liquidity. They sit on a staggering 20.5 billion pesos in pure cash equivalents. They are utilizing this massive liquidity buffer to absorb the regulatory shock without breaking a sweat, while smaller, over-leveraged competitors run out of capital. Because the regulator now caps player rebates at 1.5%, smaller rivals can no longer buy market share with excessive giveaways. DigiPlus is using its liquid room to outlast these competitors and consolidate the sector through brand equity alone. DigiPlus is currently executing a hard pivot from a purely digital footprint into the physical integrated resort space. They recently initiated an 11.8 billion peso deal with the International Entertainment Corporation, executing the first 5.9 billion peso tranche earlier this year. The second tranche of that convertible note deal is designed to secure up to a 54% majority stake in the Hong Kong-listed entity. That controlling interest gives DigiPlus ownership of the New Coast Hotel and Casino in Malate. They are securing a physical PAGCOR licensed asset to hedge against digital regulatory risks. Simultaneously, they are closing the digital payment loop. Through an exclusive tech partnership with Manny Pacquiao, they are rolling out proprietary payment gateways like MannyPay to eliminate their reliance on third-party e-wallets entirely. To ensure brand dominance in this new closed-loop system, they secured a multi-year deal to become the NBA's first official betting partner in the Philippines. By owning the physical casino, controlling the proprietary payment rails, and locking down top-tier sports licensing, DigiPlus is constructing an omni-channel entertainment fortress that domestic digital regulations struggle to penetrate. When a stock chart bleeds, the retail instinct is to run. The institutional response is to audit the reserves. The facts are isolated and clear. The company holds 20.5 billion pesos in cash, and they are acquiring majority control of a regional physical casino. Because of that massive cash generation, financial analysts are still projecting a robust 1 peso per share dividend payout for the year. At the current, artificially depressed share price, that translates to a massive 7.3% dividend yield. The 33% profit drop shook the weak hands out of the market. What remains is a highly liquid, regional casino operator trading at a severe discount.